Okay, I think that's enough time. I think we can just jump right on in and start with some housekeeping items. Welcome, good evening again. Thank you for joining us tonight for Financial Wellness and Planning. My name is Amelia. I'm a marketing manager with NVA. And thank you again for joining us. This topic is very important to anyone, no matter what stage you are in your career. And it is also part 7 of 8 of our fall education series. We have one last webinar, which will be December 8th, with the topic AVAs, the untapped resource that could change your practice. If you are interested in that, I will make sure that you get a link for more information and a link to register. There's just a couple important things before we get started. Our hostess for this evening, Dr. Steve Latimer, is very happy and more than willing to answer any questions you may have during the call or after the call. If you have a question tonight during the webinar, you have 2 options. You can select the raise your hand function in the chat menu, or you can key in your question in the chat board and I will help filter some questions out to Dr. Latimer as the webinar continues. If you think of a question after the webinar is completed, I will also share with you Dr. Latimer's contact information. You can also see his email right there in the front title screen here of the webinar. So you can email him after the webinar is complete, and he'll be happy to respond to you as he can. We'll also be recording this call, so I'll make sure that everyone on this call tonight receives that link to the recording so you can do any playback as needed. Lastly, I have to say it, any information provided on tonight's presentation is for informational purposes only, and it's not a substitute for obtaining advice or guidance outside of this webinar. With that, let's get started. I'm going to hand it over to our host this evening, Dr. Steve Latimer.
Thank you, Amelia. And I'd like to thank all of you for attending this discussion, and I'd like to thank NVA for sponsoring this. I have been a veterinarian for almost 35 years, and I've been an exclusively equine veterinarian for almost 33 years. Started my practice exclusively equine in 1990 as Northwest Equine Veterinary Associates, and partnered with NVA in December of 2019. So I'm just about to the 3rd anniversary of my relationship with NVA, and it's been an amazing partnership. Our practice has grown both financially and personnel-wise during my NVA partnership, and it's just been a great experience. I'm bringing this discussion both from the perspective of kind of a lifelong interest in financial planning and financial wellness, both from a personal and a practice perspective. And also, I've recently completed a master's degree in financial planning. And so this discussion is a little bit of a combination of personal experience, practice experience, and educational experience. And in fact, this discussion is a little bit of a high-level summary of 4 years of my master's program. So I'll just move into so I can move forward. Shall I advance this, Amelia?
You should just be able to click on it. Try clicking.
There we go. Okay, got it. Okay, so to start out with, financial wellness is, it can be defined, and essentially one of the definitions I found is financial wellness is the ability to understand your emotions around money, develop healthy emotions as well as literacy around money, and successfully manage your money. But that's such a huge range, and I think each of us needs to define financial wellness on our own terms, and we kind of need to look at our individual values, because what do we want in life? A lot of people from my generation wanted to work really long hours, and I've been there, done that. I thought it was the path to wealth, and I have realized in my 60s now that, looking back, I wish I would have worked less and spent more time with my money and with philanthropic causes and just recreation. So we really need to look at our desires and goals and values for life and kind of move forward always with that thought in mind. Don't just think about how long you have to work and how much money you have to make. From the perspective of another definition, you can look at financial wellness from both a present and a future scenario. In our present for financial wellness, we really want to have control over our day-to-day and month-to-month finances. We want to make sure we can pay our bills and also enjoy life and have the finances to do that. And also we need to have some freedom of choice. We don't want to be constrained by having a lack of money and a lack of resources, so we can't do the things that we want to enjoy in life right now, while at the same time thinking of our future. And in the future, for security, we all need to have the capacity to absorb a financial shock. We all need to have that emergency fund and some additional finances and security, so we're not left hanging out to have to incur some significant debt, whether it's credit card or loans or family loans, things like that. And then freedom of choice long-term. As long as you have in mind these long-term financial goals, so that in the future, when you are preparing for retirement or slowing down, that you can do so with the confidence and knowing that you're secure in your finances and you're not going to be stressed about how to meet those financial obligations. So this is a little bit of a bird's eye view of where our money goes. And I kind of wish someone would have mapped this out a little bit for me when I was younger, because it kind of gives you an idea of where everything needs to go and what some of our options and obligations are. And so this is just a bird's eye view here, and then I'm going to go through each one of these individually, but we start out with our gross income, and we have obviously the federal income tax obligation. You may have some state income tax obligations. There are also some pre-tax options for you, which include employer provided health insurance, an HSA, which is a health savings account, and some pre-tax retirement accounts. After that, there are 5 categories left, and that would be an emergency fund, your obligatory debt payments, recreation, after-tax investments, and living expenses. So starting out with your gross income, essentially, that's your income before any deductions. And that's going to be either your hourly wage times the number of hours worked per year, or your annual salary, including bonuses. And a typical work year for anyone who works 40 hours a week would be 2,080 hours. If you're going to have 2 weeks of vacation, that's approximately 2,000 hours. And for employed veterinarians, we know that we work a lot more hours than that. It's not uncommon for veterinarians to work at or in excess of 2,500 hours per year. And according to the AVMA, somewhere around 0.03% of graduates in 2018 entered private equine practice for a mean starting salary of only $51,893, at the same time having debt of about $152,358. We know that financial wellness and mental wellness can really be influenced by your gross income, because if you're struggling to get by, then it affects us not only in financially what we can do, but also in how we feel about ourselves. So I think it's really important for us to always be looking at ways that not only we can serve our patients to the best way that we possibly can, but also to be compensated well for it, because we've gone through a lot of education and put in a lot of hours and experience, and we all desire to be compensated more. And it's funny, in the United States, one of the big questions that comes up in conversations everywhere is, how much do you make? And internationally, that's not a real common question. There's so many other things that we could start a conversation by what are your hobbies and you know, what are your interests outside of work and things like that. So it doesn't have to be all about how much you make, but absolutely, we do need to realize that our financial and mental wellness is influenced by our income. So looking at our pre-tax deductions, health insurance, there's a multitude of different policies that you can have, but and that may be full or partial coverage from your employer, but that is a pre-tax deduction, so you don't have to pay taxes on that. Looking forward to retirement for myself, that is going to come out of my savings, and so it's a huge benefit to have health insurance supplied by your employer. And when you are negotiating, if you have any negotiation power with your employer, obviously NVA has some great options for health insurance, and so you really want to take advantage of that. The HSA is the health savings account, and that's what I take advantage of. And it's a high deductible health insurance plan. The deductible can't be less than $1,400 in 2022, and my personal deductible is $2,000. But in exchange for that, with the HSA, you can contribute to a health savings account. And in 22, the limit was $3,650 individually and $7,300 for a family. And that money, the benefit of this is that that money comes out pre-tax, and when you contribute to that HSA, any growth that plan incurs, plus what you contributed, will never be taxed. And when you take that money out, as long as you use it for a health expense, which can include health, dental, vision, then you don't have to pay taxes on any of that money when you pull it out. And if you look online, there's an incredible amount of expenses that can be deducted with the health savings account, including pre-K childcare and things like that. So there's a huge benefit to doing the HSA, even more so than a retirement account. And then your pre-tax retirement accounts that are available to you are, if you don't have an employer-sponsored retirement account, you can contribute to a personal IRA, and the limits are dictated by your income. As an example, the full individual contribution, if you're less than 50 years old, is $6,000. If your modified adjusted gross income is less than $68,000. Also, you have an option of a 401k, and the amount that you can contribute in 2022 is $20,500, and a simple IRA, the full individual contribution amount is $14,000. So pre-NVA, my practice, we had the simple IRA. It's very inexpensive for small practices to provide for their employees, but then as soon as we partnered with NVA, the 401k was available, and that's just a great option, just because the amount you can contribute is so much greater. Gross income, and so your gross income is going to be, there we go, income tax. So you have your pre-tax deductions, and then you have your income tax, and per the IRS tables, the amount in 2022 for anyone earning between $89,075 or $89,076 and $170,050 is $15,213.50 plus 24% of the amount over that. And as an example, you could contribute $20,500 to your 401k, which is the max. If you had a $120,000 salary, reduces it to $99,500. That reduces your tax owed by about $5,000. And so even though that does lower your tax, it does demonstrate the value of a pre-tax contribution, I think we all need to think about, you're lowering your tax obligation now But that $5,000 might not be a big deal long-term. If you think about later on in this discussion, we talk about doing a Roth where even though you pay tax on your current contribution, you'll never pay taxes on that again. So it's really important to consult a tax professional to decide whether you should do a regular 401k or a Roth 401k, because that could have some huge implications long-term for the amount of money you have saved in your retirement account. Okay, so moving on to the 5 remaining categories. Once we've done our pre-tax deductions and our income tax, first off is your emergency fund. And really everyone needs to have an emergency fund. When you start into practice, this should be one of the first things that you think about, because we can all be faced with an emergency that requires immediate cash. In the last 2 weeks, I've had one of my trucks had a transmission go out. One of my trucks had an engine fail. I had a trailer that had the bearings go out in one of the wheels. And those are all things that you have to have money available to pay for immediately, unless you're going to put it on a credit card, which is going to be high interest, or you're going to have to try to borrow the money. So a basic emergency fund is to have $1,000 in liquid savings or in a money market account. This kind of follows the Dave Ramsey protocol for his baby steps. But realistically, what we all need is 3 to 6 months of living expenses, because you never know when any of those things that are emergencies are going to happen. And you want to keep your emergency fund in a readily available account, nothing risky, nothing that you're going to try to earn a high interest rate in. It just needs to be in a money market account or a regular savings account. And don't ever think about spending your emergency fund on any kind of recreational or month-to-month expenses. You need to just put it in there and completely forget about it unless you need it. The only time that you need to think about it is if your income or living expenses increase, then you probably are going to need to think about bolstering that emergency fund. As a practice owner, I always had a full year of an emergency fund available, just because early in my practice, there were times when I actually paid payroll out of my emergency fund, and I'm glad those days are over with. So really with your emergency fund, you just want to think of it as something necessary for job loss, or if you get injured. If you get injured, you should have disability insurance, but there's going to be a waiting period on your disability insurance, typically 30, 60, or 90 days, and you're going to need to have some money to get by until then. Or if your car needs emergency repairs, and those are really the main things that people need an emergency fund for. Debt payments, really there's 3 main categories of debt payments. Student loans, and student loans are a necessary evil, right? And there is certainly a possibility that some may be forgiven. If there is an amount that's forgiven, what's going to happen is the amount remaining after the forgiven amount is removed is going to be re-amortized, and you'll get a new monthly payment, and so a new monthly lower payment. And so when it comes to thinking about trying to pay off your student loans early versus retirement account contributions, this is one of the places in your life where it's really important to talk to a financial planner or financial counselor for specific advice, because even though it's great mentally to really want to have those loans paid off, if you contribute to a retirement account when you're younger, just the time value of money is a huge implication for how much your retirement account can grow to. And I'll show you an example of that later on. Another thing is mortgage payments, and at least my generation, everyone wanted to buy a house. I think it may be wise for a lot of people to not buy a house anymore, especially because they're so expensive. But if you do think about purchasing a home, you should purchase it with a minimum of 10 to 20% down payment and ideally a 15-year mortgage. The main thing to think about, if you do a 10%, if you do less than a 20% down payment, then you're going to be faced with paying private mortgage insurance until the equity in that home reaches 20%. And private mortgage insurance can add several $100s a month to your payment. So you really have to take into consideration the current interest rate, the home price, and also how much it would cost you to purchase a home with less than 20% down payment, and how much that private mortgage insurance is going to cost. And again, just talking to a financial counselor is a really good place to go. And finally, revolving credit card debt. This does not include your minimum payments because that just comes into your living expenses. So the revolving credit card debt is if you pay your amounts off every month, just pay your debt payment on the card every month. Recreation is definitely something that we all need with the stress and anxieties associated with our jobs, which are significant. We really need to have outside interests and just fun things to do, right? And according to the 50-30-20 budget principle, approximately 30% of your income can go to recreation. Approximately 50% should go to your needs, and then 20% can go to your savings and your debt repayments. So even though approximately 30% of your budget hopefully can go to recreation, if your finances are tight, you may have to look at all of the things that you like to do recreationally, and you may need to reduce that until your income increases to an amount where you can afford to do all those things. Also, no matter what age we are, it's a good idea to break your recreation down between wants and loves, because we can all come up with a long list of wants, and those can be very short-term desires that maybe we would forget about in a month or a year, such as how many times we had sushi, or how many times we watched a Netflix or watched a pay-per-view movie, versus if there's some love that you are really thinking about, like going on a trip to Europe or Costa Rica, or maybe hiking the Pacific Crest Trail or something like that, then that's something you want to funnel your recreational dollars to save until you can really afford to do it, because those are going to be memorable things instead of just spending money frivolously on some short-term desires. So here's where the difference comes into play between pre-tax retirement investing and after-tax retirement investing, because the Roth IRA, the Roth 401k provide lifelong growth with no future income tax obligation. And that's kind of a freebie for all of us to have a much more secure retirement. If you can afford to pay the tax right now on that income and contribute it to a Roth account, you're likely going to be dollars ahead when you retire, just because you're never going to have to pay any taxes on any of the growth in that account. Whereas with the pre-tax, when you retire and utilize that money, you have to pay tax on not only the money that you put in there, but on all the growth. And again, it's important to talk to a financial advisor about which account you should put it into. And some of the things that come into play there is how much money you're making now versus how much money you think you're going to be making in the future, and also what you think the future income tax rates are going to be. And I think we can all assume that when we retire, the income tax rates are going to be higher than they are now. So you may always be money ahead by doing the Roth contributions. As veterinarians, it's critical for us to have long-term own occupation disability insurance. And as an equine veterinarian, I know that There was a study published from the UK a few years ago that equine veterinarians are it's the most dangerous non-military career. And we're always at risk of being injured and being out of work for an extended period of time because of that injury. Own occupation long-term disability insurance policies are not very expensive, and they always need to come out of after-tax dollars, because if your employer pays for your disability insurance, then you're going to have to pay income tax on those payments to you. And usually when you sign up for a disability insurance policy, the amount that you will receive will be somewhere between 40 and 60% of your current income. So that kind of takes into account income taxation, and just critical to make sure that you pay for the disability insurance with after-tax dollars. It's also important, as your income increases, for you to look back on that disability insurance policy during the open enrollment period and increase that amount based upon your increased income. And finally, after-tax investments. Life insurance is critical for most people. And if you are single and you don't have any dependents, any significant others, then you may never need life insurance. If your life insurance proceeds would just go to, I don't know who, I guess if you could have life insurance policy and have the proceeds go to a charitable cause of your choice, that would be a good option. But otherwise, primarily people are going to have life insurance if they have dependents or a significant other. And there are a few different types of life insurance policies. The most common are a 20 to 30-year term insurance policy and whole life insurance. And a 20 to 30-year term insurance policy is that it's going to last a specified number of years, and the premium is going to be exactly the same for every year for that specified number of years. And when that term is up, the insurance ends and you don't get any money at all. But the premiums are very inexpensive. I had a 20-year $1 million policy that had an annual premium of $1,000, so it was pretty reasonable. Because the premiums are lower than a whole life insurance policy, you can simply just funnel that to a different investment to make a higher return on your dollar. There is whole life insurance, and it is more expensive. It does last for your entire life, but the premiums are much higher. You pay higher upfront costs, and there's higher commissions to the agents. And even though there is a return on your investment with life insurance policies, the return is usually in the 2 to 3 to 5% range, somewhere in that. And some policies could be higher, but typically they are not going to provide as good of return as your typical retirement account in an index fund. Okay. So living expenses, again, following the 50, 30, 20 rule, about 50% of your after-tax income is just going to have to go to day-to-day necessities. And these include housing, food and groceries, clothing, healthcare, transportation, cell phone, internet, childcare, etc. Never mix these. Never think this is part of your recreational entertainment budget. And one of the things that is becoming more and more common is for people to actually use a budgeting app, and there are multiple budgeting apps available to use, and you can just categorize each of these expenses and track them month to month, and it can show you really where your money is going and maybe where you can reduce some of your expenses to help maybe move some of these expenses over to the savings or recreational part of your budget. So it's important to really have an idea every month, where is your money going? You know, you should have kind of an idea. You know how much your housing is going to be. You really should have an idea how much you're spending on food and groceries and clothing, just so you don't overspend in that category because it's going to be taking away from other options for your money. Okay, so moving on to the time value of money. And when you're young, it's really important to think about saving for the future, because initially it's not how much you earn on your return initially when you're young, but it's just about getting the money contributed somewhere where it's going to benefit from the time value of money. And when we think about where to put our money for long-term investments, there's a hypothesis. It's called the efficient market hypothesis, and it's the predominant theory in financial planning. And that is that the stock market, essentially all markets, contain all available information, and so there's no secrets that we can know that are gonna tell us which is the best stock to pick when, or how to time the market, when the bottom is, and when to buy in, or where the top is, and when to get out. And so even though there have been financial advisors and financial planners who have consistently beat the market, it's not been for a very long time. It's only been for a short period of time, and then somebody else winds up being able to beat the market for a while. But for individual investors such as us, the most important thing to think about is just long-term horizon, investing for your entire life, contributing regularly into broad index funds that are secure, and you're investing in the market as a whole rather than individual stocks. For thinking about how much money you're going to have long term, you can use the rule of 72, and that's simply 72 divided by what interest rate you're earning is how long it's going to take you to double your money. So if you're earning 8% interest, obviously in 9 years you're going to double your money. And so just always be looking at what your return is on your investments, just so you can look towards the future 10, 20, 30, 40 years from now and think about maybe where you're going to be. The power of compounding is I think somebody said that, someone called it one of the wonders of the world, but it's a pretty amazing principle, because you think about a chessboard, and there's 64 squares on a chessboard. If you put a penny on square one and doubled it to 2 pennies on square 2, and 4 pennies on square 3, and 8 pennies on square 4, by the time you get to square 64, it's somewhere around $92 quadrillion. And so just that power of doubling your money is fantastic for your long-term financial security. So here's an example of the time value of money. If you contributed $5,000 at 8% at age 20 or at age 30, just that 10-year difference, when you get to age 60, your money is going to be more than doubled. So the earlier you start, just that additional 10-year period can make or break a financially secure retirement account. And so always just think about, this is kind of where I was talking about, should you be trying to pay off your loans early, or funneling your money into other things versus contributing to a retirement account at a young age, so you get that time value of money ultimately to maximize the growth of your money. Looking at the differences in where people think where their money is going to come in retirement. My generation, 49% of my generation think that Social Security is going to be the main source of money in retirement. And that's a pretty scary figure when we think about in 2037, the Social Security Trust Fund is going to be exhausted. Fortunately, Gen Xers and millennials, you guys are much wiser than us baby boomers, and you're really, especially millennials, are really thinking more towards the future and contributing to 401k and personal savings, knowing that that's always going to be there. And there's just not as much confidence that Social Security is going to be there. So I thought this was kind of a fascinating comparison. Also, baby boomers, 16% of them thought the main source of money in retirement would be a pension. And many large corporations are either going away from pensions or significantly reducing pension benefits. And the problem with a pension is you may retire and think that you're going to have a certain dollar amount from a pension, and that can dry up. And there is a pension trust fund that can replace some of that money, but it's not going to replace all of the amount that you were thinking of getting as pension results, pension income. So bottom line of this is millennials and to some degree Gen Xers, you guys are smart, knowing that it's really all about your 401k and your personal savings as your retirement security. So what's going to happen if the Social Security Trust Fund is not boosted, then after 2037, everyone who's getting Social Security, their benefits are going to be reduced to 76% of their current benefits, just because it's going to be relying only on current payments instead of a trust fund. So some of the things that may happen in the future is we may have to pay a higher tax rate on our Social Security just to boost that fund, or ultimately the benefits are going to be reduced. So putting it all together, as veterinarians and as investors, we need to begin with the end in mind. And I think in the beginning of my career, I had the end in mind, but I didn't fully contribute to my retirement account when I was young, and I wish I would have. I wish I had those years in my 20s that I would have maxed them out, because it would have made a huge difference now. Educate yourself in financial planning, and there's just so much information available out there, and you can educate yourself to the point where you may even be able to manage your own finances completely on your own. I mean, you guys are just an incredibly intelligent group of people, and it's not rocket science, obviously. You can do it on your own. I have a CFP just because from owning a business, things were a little more complicated, but for a lot of things like tax planning and estate planning, it is really important to consult a professional, CPA, estate planning attorney, or a financial advisor. And you just want to make sure you avoid any get-rich-quick schemes. That's just going to be too risky. And so even though it's fun to buy into some crypto, it's pretty volatile. So you want to make sure that for your financial security for the future, that you're just investing in things that have much more stability. Live on a budget, and most importantly, don't spend more than you earn. Find a budgeting app that you think will work for you, so you know where your money's going every month, and that's going to help you plan for the future. And just don't incur any more debt than you can afford. As you get older, think about your personal balance sheet. What are your assets? What are your liabilities and your net worth? And typically in our younger years, we're going to have more liabilities and less assets. And as you get older, you want to make sure that you're minimizing your liabilities or erasing your liabilities altogether, just so that when you get to your 50s or early 60s, that you have a home, you have a stable retirement account, you don't have any mortgage payment, you don't have any student loan payments, you don't have any auto payments, just so everything you have just contributes to your net worth. Here's one of the most important things that, at least that I did in my younger years, that that is so critical to your peace of mind thinking about your financial future is pay yourself first. So automate your contributions. And when you sign up for your 401k or simple IRA or whatever retirement account you're doing, just have it come out of your paycheck before you ever see it. That way you're just going to live month to month, not even thinking about it other than when you see your statements. And it's just going to continue to grow, and it just makes it so easy. If you have to force yourself to every month transfer an amount of money into a retirement account, there may be months where you think, oh, I'm not quite getting by, things are a little tight, I'll just do double that amount next month. And then you may never do that. So if you just automate those contributions, it's going to make you much happier in the long run. Also, one of the other things that's so important is if you do automate your contributions, I know with my HSA, when my deduction came out of my paycheck and went into my HSA, it just went into a regular savings account in the HSA. And so I did have to go into the HSA account and pick an amount of money every month that had to go into my index fund. And if I wouldn't have done that, and all my contributions over the years would have just gone into that savings account earning 0.03% interest versus going into an index fund, which was earning 8 or 10% interest. So make sure that when you automate your contributions, make sure you know exactly where that money is going. Really important to freeze your credit. And you can just go to Equifax, Experian, TransUnion, freeze your credit, and that way it's going to nearly eliminate the ability of someone to take out credit in your name. So it's going to really protect you from identity theft. And it's really easy to do. You can freeze your credit in about 5 minutes, and you can unfreeze your credit in about 5 minutes. It's free, and it doesn't cost you anything, and it's super easy to do, and it's one of the safest things you can do to prevent identity theft. For applying for credit, it is really important to know your credit score. I don't know how many of you know your credit score, but it's critical, and you can go to this annualcreditreport.com and you can see your credit score. The maximum credit score is 850. You really only need to have a credit score between 760 and 780 to receive the lowest interest rates on any loans that you take out, whether it's an auto loan or a home loan. You'll get just as low of an interest rate if you have 760 versus if you have 850. And if you have less than 760, then you're going to start paying more in interest for any loan you take out. And the lower your credit score, the more you're going to pay in interest. So really try to make sure that you have the best possible credit score. It's really easy to go online to look at all the factors that combine to create your credit score. And so know those things and try to maximize your credit score. Invest wisely. If you hire a financial planner, please, please, please make sure that financial planner is a fiduciary at all times. When financial planners adhere to the fiduciary principle, that means that at all times, they are looking out for only your best interest. They're not looking for how much are they going to make in commission or how many sales they can make in a month. They're obligated to look out only for your best interest at all times. And that's a critical question to ask a financial planner. Are you a fiduciary for me at all times? Because if they don't say yes, then you need to find a different financial planner. One of the most important things for us income-wise is find a niche. And when you find a niche, do something that you love, excel at it, and advertise it. My life changed immensely many years ago when I decided the only focus in practice for me was going to be sports medicine, and it changed my life immensely. And so don't be afraid to advertise it, as long as you do everything in your power to be the best you can possibly be at whatever niche you find, because then people will search you out to utilize you for that service, even if you don't have to be board certified. If you're just, you don't have to call yourself an expert or a specialist. You can't call yourself a specialist, but if people know that it's something that you have a dedicated interest in, and that's all you focus on, then people will search you out. A little bit about estate planning. Everyone should have some type of an estate plan, even if you don't. A lot of people don't have wills because they think, oh, I don't have enough money, or things like that. But only about 30% of Americans have a will. But it's important to have a will for transfer of assets to anyone that you want the assets to go to, and to care for minor children. If you have a will, all of your assets and minor children care still has to go through probate court, but probate will adhere to how your will is stated. So it is really important to have a last will and testament. Durable power of attorney. So it's someone that you name to make legal and financial decisions for you if you're incapable. And as veterinarians, obviously, we can be injured, or any of us can be injured driving down the road. And if you're incapable of making financial decisions, then it can be devastating to your estate. So if there's someone, friend or family that you trust that is able and willing to make legal and financial decisions for you, then sign that person up on a durable power of attorney. Beneficiary designations. Both your life insurance and your retirement accounts can completely transfer outside of probate court. You just name the beneficiary on your life insurance policy and on your retirement account, and that money transfers immediately from you to that person should you die. A letter of intent is simply a letter. It can be handwritten or hand typed by you, just to carry out special requests. And these are more things like if you have a baseball card collection, or your favorite Lego collection that you had when you were little and your uncle wanted it, or something like that. Just any kind of special request that you want that doesn't need to go in your will or through probate court. Just simply write it out, handwritten and signed by you, and it's your family that will adhere to those special requests. Similar to the durable power of attorney, healthcare power of attorney, your named agent can make mental decisions on your behalf. And these are usually end of life decisions, basically as far as, is it time to unplug you or not, based upon your medical decisions. And finally, guardianship designations. If you have minor children, you name a guardian who accepts the responsibility, both welfare and financially, for raising your minor children. One of the things that can be incredibly helpful to the guardian and to get someone to accept doing it is take out a life insurance policy on yourself that is sufficient number of years until your children are not minors anymore, and name the guardian as the beneficiary of that life insurance policy. Because if that's a trusted person, that amount from the life insurance policy will go to that person who can utilize all that money to help raise your children. Finally, succession planning. Corporate versus private. I swore for years that I would not sell corporate when corporations were first buying private practices. And it really came down to not only the corporate culture of NVA, but also how much they paid for my practice. And so the finances selling corporate was just, there was no one privately who could provide for me what NVA could provide for Northwest Equine. When you're selling, let me step back just a second. Also, when it comes to corporate ownership, something that's really important for any of you as employed veterinarians to consider is NVA allows you to buy into the practice. And 2 of my associates are now practice owners. I'm only a 20% owner, and 2 of my associates are percentage owners. And as a percentage owner of the practice, you are entitled to dividends based on your corporate ownership. And in the past 3 years, my 20% ownership has just about doubled my income. So practice ownership is a way that you can easily, substantially increase your income. And NVA has a great path to percent ownership in the practice. And just talk to NVA about that, because you don't have to just come up with the money immediately. They can help you with a pathway to percentage ownership, because it's not only good for you financially, but it provides stability to NVA for the practice too. For practice selling, EBITDA, which is earnings before interest, taxes, depreciation, and amortization, is the #1 thing they look at. A multiple of EBITDA looking back 3 years. And so if you're a practice owner, the main thing with that is maximizing your net income in the practice for 3 years prior to sale, and don't charge any personal expenses to the practice, because it will rob you by multiples for what you're going to be rewarded with. Plus, it's illegal. And also remember that although you are in the animal care profession, the only way that you are successful is to remember you're in the business of making money. And no matter how much we love our profession and are dedicated to the health and welfare of our patients, if we don't make a good income, it's going to affect us mentally now and financially now and in the future. Because the amount of money you save and invest today completely dictates your retirement lifestyle. If you don't save now, you will regret it in the future. And I kind of like the idea that Stephen R. Covey here, the statement that Stephen R. Covey had from the 7 Habits of Highly Effective People. But basically, that really our true success and happiness is how much we adhere to the principles of character: integrity, humility, fidelity, temperance, courage, justice, patience, industry, simplicity, modesty, and the golden rule. Remember, do unto others as they would do unto you, right? And finally, there's a few reference books that you guys can look at. I've read all these books. These are great books to just help you out with your own personal financial education. And each of them has a little different approaches, but I'd encourage you guys to, all of these books are easy reads. There's like, day or weekend reads, and they're all incredibly helpful. So that concludes my presentation.
We actually have a question. I'm not sure if you can see it, Dr. Latimer. Ashley had written in the chat box, how do we determine if someone is fiduciary financial advisor?
Can you hear me, Ashley?
We can hear you.
Okay, perfect. So the best way to do that is face-to-face or via email. Ask that person if they act as a fiduciary at all times for you as a client. And they have to answer that question truthfully or not truthfully, because they're held to that standard. The certified financial planner is the #1 planning individual that is held to that standard, and they can lose their accreditation if they don't adhere to that standard. But yeah, that's a really good question. You just have to ask them face to face, and it's really good to get it in writing or in an email that they act as a fiduciary at all times. And it's really important to do the at all times, because some people act as, they'll say, oh yeah, I'm a fiduciary, and maybe they're a fiduciary for your index fund account, but then if they're going to sell you life insurance, they're not going to act as a fiduciary. And so that's the most important thing, is just to make sure that they act as a fiduciary at all times. Is that good?
I think that was good. So right now there's no more questions in the queue. If anybody has any questions, now would be a great time. I would also be happy to take anybody off of mute, so you can have more of a conversational interaction here. Or as I said before, you can type it in the Q&A or the chat function below. We'll give it a minute just in case. And if you think of something later, like I said, I will also be sending Dr. Latimer's email address, his contact information for anybody who thinks of something later, because that happens. But as I said before, this webinar was recorded, and everybody who attended the call today will also receive that link to the recording in their email, most likely tomorrow or Monday. We are right at time.
Perfect.
Does anybody have any final questions? If not, Dr. Latimer, if you're okay, we could end the webinar.
Great. Thank you, everyone, for attending. Thank you, Amelia.
Thank you, everybody. Have a great evening. Thank you.
Thank you.